We got the 90-day pause, and trade deals just don't seem to be happening. I really do want to talk about gold, because there's some stuff with this whole Elon and Trump, right? Somebody asked me, does that really impact the markets all that much? And the answer to me is actually yes. It's actually a really big deal because, I don't know where you guys sit on this. Of course, it's a very controversial subject, as everything these days is. But the frustration that Elon Musk had, in some ways, calls into question the national debt. That is really what it all is centered around. Elon believes strongly, whether you believe in his approach or not, clearly him and many others is a bipartisan issue, that the U.S. national debt is simply unsustainable, and could lead to a sovereign debt crisis. You want to talk about an actual threat to America? There it is, right? National debt blowing up would be a massive, massive problem. And so Elon Musk expressed a lot of frustration last week with Trump and the bill that they're trying to pass and all this, because they, look, this is nothing new. And although Elon Musk has plenty of criticism, this has been a rotating wheel. Democrat, Republican, doesn't matter. The story remains the same. Politicians claim they're going to cost savings, they're going to cut spending, but then the whole system is designed for more government spending all the time, because all the elected officials, many of their sponsors, benefit tremendously from massive government spending. And if they don't vote on those things that keep spending more and more money, they get kicked out of Congress. It's a broken system, and this is why, part of the reason why I am sort of always subtly in the bullish camp for gold, because gold in some ways offers some safety from a debt crisis blow up. Ray Dalio, the famous investor, Bridgewater Associates, he managed a huge hedge fund, super successful. Dude, I've listened to him talk about gold in the past as just having a bit of it in your portfolio. I think I've seen him say like 5 or 10%, I can't remember exactly, but having the all-weather portfolio, I think, has some allocation to gold just sitting passively. I can't remember if it's 5 or 10% of the portfolio. The famous Ray Dalio all-weather portfolio is the idea that you can have a portfolio that should do relatively okay in good times, bad times, horrendous times, and amazing times. You're not going to do, it's underperformed over the long term, but if you're looking for something that's relatively safe, right? The classic Ray Dalio all-weather portfolio has some allocation to gold. And the idea is, like, if you get some sort of debt blow up, gold would probably skyrocket, right? And so there's this idea that having some exposure to gold could be a very strong catalyst, or a very strong hedge in the form of a diversified asset that actually would do well in a debt blow up. So anyways, when it comes to gold, I am always sort of in the bullish camp, but there are times where I'm trading it more aggressively, or there's times where I'm sitting out. Right now, gold is getting a +6 on the Edge Finder. Specifically, I wanted to look at the commitment of traders data to see what institutions are doing with gold. And what we can see here is that when we look at the gold weekly filing, there was a decrease in short contracts and an increase in longs. So institutions bought gold in the past week. According to the Edge Finder's commitment of traders data, still puts us at 81% of positioning is on the long side for institutions. Very interesting to track that. We can also take a look at the COT data history and pull up gold here for a second. And what we see here is that the overall net positioning, or open interest in gold, has been declining, like less positions, both long and short, I guess. But noticeably, the percentage of longs ticked up here recently. We've seen a little bit of net buying. This yellow line has been kind of in decline for a little bit. But for the first time in a while, we now actually see some net accumulation on gold when looking at institutions. So I do like the idea of potentially getting long gold. Specifically, I like it a little bit more if we get a dip down into this 3,200 to 3,250 range. I'd be interested in taking a stab possibly long there if the edge finder still gives me a bullish confirmation. We have CPI this week. Let me just take a quick look at the CPI data and how that's currently impacting gold. So if I look at inflation for gold, yeah, so we had cooling inflation last time around. That was very bullish for gold. So we do stand to lose more points than we can gain here on inflation, if you think about it, right? Because the edge finder for inflation on gold goes -2 possible score to plus. Actually, I think it goes, I have to double check, but I believe it goes 2 to -2, or it's -2 to +3. I think there's a one unique scenario for gold where it's possible to get a +3 score. Anyways, inflation this week is big for gold. If we're going to continue to see gold upside, you really want to see inflation continue to come down. So we get inflation report, I believe, on Wednesday. So it is a big week on that regard. We've seen inflation come down, go sideways, come down, start to rise, and now has been falling. We've had 3 consecutive better than expected CPI reports here, guys. But with today's number, or I'm sorry, with this week's number, let's just take a quick look and see what are we expecting for CPI this week. And I think it's Wednesday. Yeah. So Wednesday, we are actually expecting a tick up in inflation. You can see the expectation here is 2.5%. So the market is actually expecting this number to go higher, up to 2.5%. So we'll see if that happens. But what if you get, for example, another 2.3% reading? That would show inflation is really quite soft and would probably suggest that the Fed could cut rates.
Market analysis, free trading courses, edge finder data, and special offers. What do these things all have in common? They're all available for you right now inside of our free Discord. You can click the link down in the description below to join the free Discord today and get access to all of this and more. Stay up to date with all the latest trading information and A1 content. And if you want to upgrade to our Gold VIP Discord that features every single trade that Trader Nick and our other professional analysts take, you can find the links for that in the description as well. So don't wait, go check out the free Discord today.
Also still bullish on the indices, although not looking to like add a bunch of trades on the indices. So if I pull up, for example, Russell, I'm in this trade. I've trailed my stop. I trailed it earlier in the stream. For those who are just arriving to the show, I just trailed my stop loss. If you're a VIP member with us, like I said earlier, update has been shared inside of the Discord. So if you'd like to keep up with those trades that I'm sharing in there, they are in there now. But if I'm looking at like NASDAQ, for example, I mean, this chart looks amazing. I think it's headed higher, but that doesn't mean I'm gonna like buy it here, right? So like I'm already in the Russell pullback. That was my pick of the group, and I'm glad that I did. It's up quite a bit here today. It's up almost 1%. NASDAQ is flat on the day. Same with the Dow and the S&P. But when I look at these things, I say, okay, I'm bullish, but I can't just buy them at the current levels. I have to still wait for the chart to come to me. So I like the NASDAQ. I like the S&P 500. Last week I spoke with Marco, who comes on the show pretty often. Him and I were talking about the indices, just about how, you know, the indices have not given a whole lot of pullbacks. Like this Russell trade, I barely caught it. Like it shot lower, and then like I got it on the rebound, but I still felt like I was, you know, it was so brief. The indices are so strong right now in terms of their price action. It's been very difficult to catch any sort of pullbacks. So I caught this one, and so I'm in the Russell, but the other ones have just not even given me much to work with. You do have the DAX. This is another one. I don't know if this is still bullish on the, is it? Nope. Back to neutral for the DAX. Possibly some economic data. I'm seeing PMIs came in soft a little bit for Europe last week. So that might have hurt the DAX trade for me a little bit. But if we pull back and we get some better economic data out of Europe, DAX might be interesting to me. So I do love the technicals on the DAX. The DAX looks so strong. If we took German 40 and crossed it against SPX 500 really quick, you can see here, this is the German DAX versus the US S&P 500. And you can see pretty much all year, DAX has been dominating, right? The DAX is kicking butt, looking really, really strong. So back to S&P 500, we had a really nice bullish week last week. Like I said, I think we are headed back to those all-time highs. But the only way I would take trades on the indices at this time would be pullbacks. So I'm sitting in the Russell trade, waiting on the rest. Dollar index, we talked about it briefly earlier. We are sitting at support. We had a good NFP report, which I think saved the fallout here, right? We were looking like we may plunge lower on the dollar, but then that NFP report came in relatively stable, right? So you had on the jobs report last week, just a quick recap, NFP did beat. It didn't beat by a lot though. Glenn is our next one. They've been trading for 3+ years. We saw gold and equities pushing higher together as opposed to their usual inverted price correlation in Trump's first term, and due to a host of reasons like the baseline uncertainty Trump brings to the table. And now since he took office in January, we are seeing a very similar situation. What are your thoughts on this, Nick? So Glenn, interesting concept, but I will respectfully actually reject your thought that gold and indices are inversely correlated. In fact, gold and indices typically are more correlated than inversely correlated. They actually tend to move. What you're probably thinking more of is actually the dollar and indices have, even then there's not like strong correlation. Just because the indices go up does not mean gold has to go down, or gold, like maybe you're thinking of a specific time in history where there was an inverse correlation, but we can actually look at this, right? So if we take a look at SPX really quick and we just we do a comparison of XAU USD and apply this, what you'll see here is that the correlation coefficient here, I'm just going to do an area chart. Check this out. So, this idea that gold moves up, stocks move down, and vice versa doesn't really hold up very well when you actually apply the data to it. You can see it's all over the place. There is no decisive correlation. There are periods of time where they move inversely. But again, like what I was just saying, most of the time, there's actually more of a positive correlation between stocks and gold than the opposite. What are your thoughts on this, Ivan?
There is a Norwegian saying, comparing apples and pears. I feel like this is apples and pears situation. Because I would argue that what drives gold doesn't necessarily drive S&P or NASDAQ. And what drives S&P can drive gold in the same direction, but it's not always. So you have to look into what drives S&P more than anything else. It's the US economy, how the businesses are doing, and most likely the top 7 of the companies doing, and the US monetary policy and also governance. But when it comes to gold, you also have other in addition to that, you have also the risk of the global downturn or greater improvements. You have demand for physical gold during certain times of the year, and now because of China doing so poorly economically, they have bought gold instead of having their own stock. So there's a bit of a different mix to why each of them drives, in this case, higher.
That's a great way of putting it too, Ivan, because like basically, that correlation, it goes in and out based on what you're saying, based on like what's happening, right? So if the Fed is cutting interest rates, is that good or bad for gold? It's good for gold. Is that good or bad for stocks? It's also good for stocks, right? So the Fed, you have to look at the Fed. You have to look at the economy, as you've pointed out. You have to look at central banks. You have to look at geopolitical events, right? I think it's, markets, while they do often rhyme, they never exactly repeat. And by being a fundamentalist, by being a macro trader, you're studying these things and thinking through how the current environment, which has never been the exact same in history, right? There's never an exact copy. You have to kind of take every little piece that moves markets and try and align everything and say which markets look like they're the biggest beneficiaries of the current environment, which ones look like they're going to be the biggest losers in the current environment. So the idea that stocks up, gold down, and vice versa, I would leave that in the past. That's a bad, you hear these things all the time. Ignore them, right? Study them yourself before you think, oh, if the dollar goes up, stocks have to go down. Well, go test it. We just did a really quick example. Pull up your correlation coefficient and check what you just said to make sure what you said is not ignorant to the reality of the market. So it's not, I'm not, trying to be harsh to this person who asked that question. It's a great question. But consider, like Ivan suggested, looking at the individual components that impact your charts that you're watching. Don't just do a blanket statement of, oh, well, gold and stocks should move inverse to each other.
It also comes down to dollar index as well sometimes, and they say that they should be inversely correlated to the stock market. It's not necessarily. The same thing with CAD and oil. It's not necessarily, and I think it's just 30% of it correlated. So 70% it's not. So it's more of, as I've always said, and I'm always going to say, what drives the market. What is the driver? And each currency and each asset and each class has different drivers, depending on how they are supposed to perform in a portfolio, and that should be your leading driver of whatever you're doing.
Right, exactly. For the first time, not seen a session with Chris before. He's been on the show for quite some time with us, sharing insights on markets. And that being said, Chris, we haven't spoken in a minute, and I hope you're doing well, man. But I also wanted to ask you specifically about this recent rally. How much more juice do you think this thing has? I mean, we're almost back towards, believe it or not, back to those all-time highs. I'm pretty shocked by it. What are your thoughts?
Yeah, that's probably the likely destination. I mean, at this point, since we didn't really have much of a pullback after that U.S.-China trade agreement gap, I mean, yes, we pulled back to pretty much test it. We didn't fill it. I am thinking that this market just wants to get to all-time highs. I think that it's disappointing to feel like there was very little opportunity to really participate with a technical pullback, because even running into major resistance around all those moving averages around I'm talking SPX here, like 56, 5700 zone, that US-China gap just kind of threw things higher. It's like at that point the bears just kind of gave up. Yeah. So all we've seen these last few weeks, it's like price really hasn't gone aggressively higher, but it's like every single day you can notice intraday price action is just trying to melt up. And sitting here watching where we're currently at just over 6,000, that was another kind of round number, had a little resistance off it with the Musk and Trump drama last week. Markets don't seem to care. I think just the easiest thing is going to be, if we just melt up to the highs, okay, fine. I still think a pullback is likely going to happen. I wouldn't be aggressive at all-time highs. I mean, that's just me. So thoughts on that, Nick? I mean, we could clearly go into a melt up, but there's still a lot of things the market's going to have to digest through the summer. This first kind of 90-day pause through tariffs, that'd be in July. Powell, Trump is calling out Powell again for cutting rates. And if more stuff happens with Musk and Trump, who knows? But we don't know, how the negotiations are going for like global tariff conversations. U.S. data, it's all like the same uncertainty is still there. It's just the market just doesn't care anymore. Like right now, it just seems the market just doesn't care. So I'm not upset about watching new highs in the portfolio. I'm not. I'm just I saw some of the posts you had last week. I mean, how aggressive are you right now? At all? I mean, just kind of enjoying the melt up? Are you participating actively? I mean, I've tilted, so I mean, I'm seeing some fresh highs. I talked about this last week. If we go to all-time highs, I'm probably going to see like 275 to 280 in the portfolio, which is fine. But I mean, so I've got some bigger plays. Like actually, uranium's been taking off quite a bit for me. Gold and silver are doing pretty well. Silver's had a nice run last week, so those little like holding trades for me are still like generating some juice, but. Yeah. Other than that, it's just kind of, swing trading the indexes and trying to stay out of the way and let this melt up happen.
I'm kind of in the same camp. I've got a long position on the Russell right now, which has gone pretty well. IWM, so I'm long IWM. I've got a big basket of tech stocks that I picked up during the sell-off, so I've done pretty well on that side. I sold covered calls on several names that I have in the portfolio just with this move. I do think we're getting a little bit stretched. But where I see, to your point, Chris, about maybe just making that move back to the all-time high, what I think is fueling it, what I think gives it more juice, is sentiment is still convinced it's the other way, right? We've seen, looking at the investor sentiment surveys, we've seen persistent kind of negativity around markets. We're still above historical bearish averages at 41.4%. Then you take a look at the put to call ratio. Put to call ratio has been still on the upper end. Put demand is still very strong out there. And so, to me, Chris, I think, while I don't necessarily think that we take out all-time highs and then just it's a forever melt up, I think Trump kind of continues to introduce and keep that volatility somewhere in the back pocket all times.
Right.
I do think that this thing can continue to climb that wall of worry that is so clearly still the case for a lot of sentiment out there. One of the things about 2023, I know you did well in 2023, the bounce back after that big fallout year in 2022. The big bounce back year was, built on just this pessimism around we're going into a recession and all that. So, we may be seeing a repeat event of just climbing that negative sentiment despite the odds. I think what we have behind us now is like, okay, Trump seems to back down every time things get really real when it comes to tariffs. And I think the market takes that as okay, the Trump put is there. And, the Trump put is there. Fed probably wants to cut interest rates this year. Earnings came in pretty good and sentiment is still negative. I feel like that's a recipe for at least a retest of those highs.
I agree. The only potential flaw of the next month would be that there's a blackout window for buybacks in these next 2 to 4 weeks. So that we had record level buybacks this year, which I think was overall a boon for this little melt up. China and US talked apparently last week. They're supposedly in London this week to talk more. So what we quickly learned after April 9th was this whole idea of tariffing the world is really about the U.S. just trying to rein in China. That's really what it is. And if the U.S. is trying to also get into the metal space or the refined metal space for AI infrastructure, one thing that I keep looking at, Nick, is even though this is a melt up to all-time highs, we're still way off these lows on Liberation Day yields. Global yields are rising. At some point, it's the rate of change that really shocks the market. So this slow, consistent move up in yields is going to be a problem at some point. If 10-year yields are up to 5% and crossing fresh highs, that's a problem. That's where we start to see some of this topping back in.
Yeah.
I was
a little pullback. What are your thoughts on TLT, Chris? Because I heard you. I listened.
I want out of it, dude. I don't want to hang on to it. I
Okay.
think that there is a lot of support down here, but honestly, if I had, I'm still in it, but I'm using a diagonal spread. My break even is $85. And I'm just going to actively kind of sell it because I'm out till 2027. I've got plenty of time in the trade, but for every 30 to 45 days, if I'm just selling calls, again, it's a diagonal spread trade. So I've got a long dated call option. I'm just selling against it to lower the size of the debit. So I want out of it because I'd rather be in gold or silver or Bitcoin. That's kind of my whole allocation is never mind TLT. I don't want to be in it anymore. Give me the diversification for gold, silver, Bitcoin. That to me is a better play than TLT.
Chris, so we can get just into the weeds for just a second on. I don't want to. It's not the point of the show to get too political, but the whole Elon Musk and Donald Trump fallout did have me thinking this weekend. And to your, that's why I asked about TLT is, politicians, it doesn't matter which way you lean, red or blue, right? In the United States, the challenge that I see and the long-term bull case that I'm a forever bull on gold on the big picture. Yeah. And I know you are too, right? The idea though, that the national debt keeps climbing and there is no true incentive. In fact, there's strong disincentives. I don't know if that's a word, but opposite incentives to not cut spending. There is no way, and I think Elon Musk kind of had his meltdown and went to Twitter over realizing that he may have helped Trump get into the office, but it's not necessarily a Trump thing or a Biden thing or a red thing or a blue thing. It's just that the way Congress works, to keep seats in Congress, you have to administer to your sponsors. Your sponsors want you to keep spending money massively, frivolously, and it's a problem. The whole system is built on never-ending government debt rising, spending more money, raise the national debt. It's concerning to me because I'm like, okay, do I really want to park a whole bunch of money in TLT? Well, the thing that I see, Chris, the challenge to all this is we have this national debt rising dramatically in a peacetime. What if we go into a wartime? We also have national debt rising dramatically. And the reason it hasn't blown up, I think, is because GDP growth has been pretty rock solid for the last few years, despite everything. What happens when we lose one of those two stories? What happens when we go into massive, well, hopefully never, but I don't really see this happening. But if we enter in some scary wartime environment and printing money like crazy happens, right, or we lose the GDP statistics, let's say that grind higher in the 10-year causes just national debt to become so unsustainable that we're using all of our GDP to pay. Like, there is a scenario here where I'm like, if it all falls out, I don't want to be in TLT. I want to be in gold.
Correct. Yeah, and think about the scenario where, okay, so this administration, when we first started, was the first real accepted austerity that we've had in the U.S. for a long time. Like, when Trump got elected, it was about, let's fix the government, right?
Yeah, right.
Get rid of corruption. That's why we have Doge. And you can see the consensus. Like, people were supporting the idea that Trump can Musk can come in and try to cut $2 trillion. That was the plan. They cut a couple $100 billion, and then obviously there's been a huge disconnect now that Musk is like, look, call your congressman, call your senator, get this bill killed. Like, this is terrible. This is going to add, everybody knows it. Everyone knows it's going to add $2.4 trillion to the deficit. And again, red or blue, it doesn't matter, because you can go back historically and see for the last 70 years
they all do
that they've all added deficits. Like, in fact, Republicans, believe it or not, everybody, Republicans are worse at adding to the deficit, because you've got socialism for the wealthy with the Republican Party. You've got socialism for the poor with Democrats. Democrats are not doing themselves any favor after losing this last election. I don't know if they're doing anything good to get votes back at all. But my point is, so we had supported austerity that quickly pivoted April 7th, right? Once we had Liberation Day on April 2nd, we had the dump on April 7th, and then April 9th was this big pivot. We went from austerity, crossed it off, that's not going to happen anymore, to now there's the Trump put, to now let's go to, we're going to grow our way out of it. We're going to grow our way through it. Nick, we're at 22 times earnings in the S&P. We can't really grow through it at perfect earnings right now. We can't grow through it at these all-time high valuations or these high valuations. So I think the third part of that is, okay, so we don't have austerity. We say we want to grow through it, but we really can't at these levels without having a better correction. We've got to grow from like a 14 times earnings, not a 22 times earnings. Yeah. And then the next thing that's left is print your way through it. More like add to the deficit, more money in the system, more liquidity.
Which is always
and that's what we've always reverted to. That's all. Ultimately, we have been spending every year like we're in a COVID crisis or great financial crisis type situation. We're just throwing that in the markets. Yeah. And I do think that the U.S. has kind of carried the world through COVID and into now. Now the other part of the world is catching up. So like Europe is spending more money, China's spending more money. And that's why you and I've talked about this, but like, my bigger concern is like we just go into a global melt up, and the dumbest thing is that the market just keeps going higher, but ultimately it's still going to give back 30% or 40% or 50% at some point.
Chris, the classic, I agree with your census there. I mean, that's the worry is that these resets need to almost happen. It's like breathe out, breathe in, and we've talked about this for years together about how the Fed saves every little dip. And I guess it wasn't really the big savior, I guess, in the recent sell-off, but that was kind of a self-inflicted thing with the whole tariffs and then no tariffs.
The Fed was quiet, but that was all Trump, and that was all a Trump pivot. That was all a Trump pivot. Yep.
And so, I think that's that is where I'm like, okay, I look at that and I say, this is why for traders, investors, most of the time we do these streams, Chris and I have collabed on these streams for a while. And most of the time it's kind of markets grinding higher, but then every once in a while you see how vicious the market can be when it turns down. You get a VIX that spikes. And I think that we always talk about this, about how when you get to low VIXs, it's very simple, but you probably want to at least be considerate of, okay, another one of these is coming. Like another one of those is going to come at some point or the other. How are you going to deal, not when or not if, but when that happens again? And, Chris, you and I was talking about this earlier on the stream about kind of our situation that we went through in August of last year, and how August for me absolutely was so painful because I gave back so much of my gains due to some really bad slippage on that one. I think it was August 5th.
It was a weekend. It was the SOM rule. So Thursday, Friday, Monday, because that huge, like, futures opened way lower on Sunday and they just bled all Sunday night, and then coming into Monday's open, it was like a 3 to 4% gap lower. And there was the liquidity was brutal on that day.
And so I was trading the Qs on that day. So of course I didn't get the futures. I couldn't close out of anything in the futures. I was trading Qs. So Qs open up, boom, get stopped out, and market, bounces back. Really painful. But my point is just, for audience listeners, just be considerate I think the VIX should be on everybody's chart, to be honest, or your watch list. I think everybody should look at the VIX and just say, hey, where are we at? Okay, we're in a relatively calm environment right now. How do I want to just be aware, be present currently, and say, okay, I know I'm not going to stay oblivious to the fact that this won't be here forever. It's going to go back up at some point. It may stay here for a couple weeks, couple months.
Right.
But how are you just going to be positioned? And I just think that's something we should always think about. It's something I always do think about. But there are those things that I just got done talking to you about, the sentiment stuff, kind of still remaining a little bit cautious. That tells me I think we may have a little bit of room for this to kind of keep squeezing, but we're also coming up, Chris, to the end of those 90-day pause timelines.
I think that's probably the market's next big window is, okay, so let's see, and here's how simple it could be. We get to 90 days, and what's the US going to do? Probably just extend it another 90 days.
Did you know we do a live trading show Monday through Friday with guests from all over the world? To get notified when we go live, click the bell button next to the subscribe button, or check in at 9:30 a.m. Eastern Time. We have helpful, free content in the description below and on our website, a1trading.com. Thanks for watching today's video, and we'll see you tomorrow.